Who benefits most from low interest rates? Inflation just printed its lowest levels here in the U.S. since 2021, the first print below 5% in more than a year. And I'm looking at core inflation as all inflation, CPI, including food and energy, printed below 5% last meeting as well, or last data release. And you can see the trend lower here in U.S. inflation, which is a good thing for U.S. consumers who were worried about, man, if I've got X U.S. dollars and I buy this many goods and services every year, and they're going up by 5, 6, 7, 8, 9%, that's not good. I want inflation to be moving lower, but U.S. dollar, as we're seeing here in just a second, depreciating against foreign currencies. We'll get into that nuance in just a second, but first, the middleman interest rates are moving lower as a function of this inflation, because remember, interest rates moved higher. The Fed moved interest rates higher, and Treasury rates followed, as they're largely influenced by what the Fed does. The Fed essentially sets a benchmark, so to speak, of interest rates, and the 2-year, 5-year, 10-year, 30-year Treasuries, those interest rates move on a relative basis, highly correlated to what the Fed is doing. So inflation was moving higher, interest rates were moving higher. Inflation now the most under control it's been in the last year, and interest rate projections are moving lower as well. As we're now at 4.9% core inflation, the Fed wants their 2% target. They've said recently that it's probably going to be at least a 6-month to 1 year plus process to get down to 2%. But the better than expected reading we're seeing today, as well as a couple of other good metrics we've seen in the last week or two to start off in July, has been worth 25 basis points lower in 2-year rates as they've headed away from their highs. And this begs the question, who is this good for? Because as inflation was spiking and interest rates were rising, a few different parts of our economy were hurting as a function of that. And of course, it's never one for one, especially when you're talking about stocks that have CEOs and boards and different products that can be doing well or poorly for whatever reason. But we can draw some correlations here. And one of the most direct ones, as you might imagine, is real estate. Real estate tends to outperform amid low interest rate environments. Lower mortgage rates can increase real estate demand. And it's funny, and this is a good point towards how much these things fluctuate constantly. It was just a couple of weeks ago. I even think I saw some tweets just over this past weekend about how mortgage rates highest they've been in decades, and the effect that they're having on potential home buyers is the worst that it's been since the last time inflation was so high in the 80s. And that is still very much true. And that can turn on a dime. And it's turned the opposite way, as we've seen. Now inflation this week is printing lower than we expected. Interest rates are now expected to be lower than we thought last week. And you're seeing real estate stocks and the real estate market bounce back from this lower than expected inflation and these low interest rates. And you see here in red is the real estate sector of the stock market. And especially in 2022, as interest rates marched higher there in the black line, that's the 2-year rate, marched higher from 3% on to 4% and close to 5%. Real estate stocks moving directly lower. This sector ETF moving from $46 all the way down south of $36 as they lost about a quarter of their value as interest rates rose. Interest rates come off a little bit at the end of 2022, start of 2023, real estate bounces back, and then you see again that move higher in interest rates. March of this year, real estate stocks make another trip to their lows. And now recently, as interest rates have come off their highs a little bit, and we'll see where they go from here. Not necessarily going to be a straight shot to the bottom, but you can see the correlation there. Interest rates moving lower, real estate moving higher. And I thought I would draw some actual concrete correlations over the last year's worth of price action from all of the stock market sectors. And these aren't the strongest correlations, but they are the strongest correlations of the sectors that we looked at from our economy here. And you can see real estate at the top. And then right next to that was consumer discretionary. And so that's going to be, your Nike, your Lowe's, your Home Depot, your Amazon, and anything that is directly seeing consumers spend money. And that makes sense, right? I mean, if inflation is high, interest rates are moving high, then consumers are going to spend less. That's the whole theory behind why the central bank would move interest rates higher, is to slow down money. Now, if inflation's under control and interest rates are moving lower, then those stocks that profit from consumers using their money, moving their cash around, buying new Nikes, buying home improvement stuff at Lowe's and Home Depot, that's going to be good for those stocks. And then tech as well, as tech does quite well off of low interest rates, helping to promote their growth. Those have been the strongest correlations and the sectors of the market that are due to perform best if interest rates are moving lower. And then also, just as a snapshot here today, because today's a good example of pretty direct, inflation metric comes out lower than expected. Interest rates thus are moving lower. So what's moving higher? And you're seeing NVIDIA, big outperformer today. Meta also up 3.5%. AMD, another chip maker, tech stock up 2.9%. CRM up 2.7%. And then financial stocks as well tucked in there, outperforming here, and then Texas Instruments. So you're seeing an interesting mix there at the top, but tech, finance, and then also those consumer stocks not far behind on today's best stocks, owing to the correlation, and then real estate, obviously, from a consumer level, but also from a stock market level, performing well. And the one piece that we didn't touch on, but will in the future, something that's not performing well as interest rates move lower, is U.S. dollar. It tends to be a pretty positive correlation with interest rates. That is, interest rates moving lower, U.S. dollar moving lower as well. Of course, these are all historical numbers. Anything can change in the future, and inflation can jump back up above 5%. Interest rates can rise again. But at the moment, seeing lower than expected inflation, leading to lower interest rates, leading to certain parts of the stock market outperforming.